Hey, this is David Skrika. So this is the stock chart of the day will be coming out on Friday. Oh no, coming on Thursday. Thursday. I don't know if I'll do one on Friday. One thing you have to understand about stock chart of the day is it's supposed to be a 4 to 5 week service, and then once to twice I put out things that talk about more of the positions, what we're trading, more in-depth look at markets for the paying members. So 4 to 5. I'm flexible on the numbers. If it's an active number, I might put one out Friday because yeah, it is the jobs number. So I'll probably will put out one Friday talking about the jobs numbers. And sometimes I do like to put one on the weekend too, because look, I don't know how many of you are football fans. I'm a huge football fan. I do watch Premier League. I'm a big Leeds United fan, and they're in the championship right now. So that's Saturday morning. But so my Sundays are pretty boring right now in terms of just, maybe I'll go hang out at the beach for a bit. I'll do some work. I'll clean up around the house, but it's not much going on right now, on Sunday. So, and I don't think a lot of you are in the same boat. So I noticed that Sunday videos I do get pretty good views. And I think it's because a lot of people are just in my boat where they're just sitting around, and even if you have things to do with your friends and family, it's like, how much time does it really take to watch a 10-minute video, right? So today we're going to look at the interesting correlation between now and 1987. So there's something I want to talk about first, which I think is interesting. In the 2987 crashes is the first thing that I talked about actually in my book, Stock Market Panic. So if you can find this on Amazon, you have to use Dave, not David. This is a cool book I wrote too called The Country. Chair Who Saved the World. But Stock Market Panic, it's only got one review, but this book is 26 years old. It was published in late 1998, and you can see that so one of the things I talk about is an interesting correlation of both 29 and 87 is that the market crash happened exactly 55 days after the market peaked, and that's total days, not trading days. So that was an interesting fact I learned at a very young age. So if you're going to get one of these 1 or 2 day crashes, that's about what you're looking at. And usually they tend to occur on Monday. And I think it's because people get nervous over the weekend. They get their margin calls coming in and they just kind of panic. Maybe they read some negative headlines. Usually the Friday is a rotten day. And then, if you look at 1987, we'll show in a second, it was down a lot. And maybe because I'm talking about this, maybe next week I'll do Martin's Wag and him predicting the 87 crash as my legendary trades series. So So this kind of thing here is that's an interesting correlation. So, and seasonality of trading, selling may go away, but again, those crashes happened. It was early September and late October in 1929, and it was mid-October on the crash in 87 with late August in 1987 being the top. So I think August 24th or so, or 25th was the top, and the 19th, I know the 19th of October was the crash, and September 3rd was the top in 1929 with, I think it was the 29th or 30th was the crash then. And again, so in 29, it was a 2-day crash, Monday, Tuesday, and then in 87 was a 1-day crash on the Monday. So anyhow, but what I want to show you with that seasonality is that in 2021, even in a great year for the market, if you had sold, say, in August, worried about some kind of crash because the market had been booming, there was this correction into October, and then the market kind of took off, right? So you could have there, and then and then in 2022 when the market fell again, there was another peak in kind of August here, and then the bottom happened in October. And same thing last year. Last year I actually got very defensive in this area here, and then I got back into positions here. So because if it doesn't usually happen by the end of October, it's not going to happen. So my feeling is that depending on how the market trades, you can always have something happen early, like in 2000. I think it was 15. The market kind of tanked at the end of August. So anyhow, but that's something to look forward to. And I'll probably, even in an election year, get defensive. And I think one thing that could cause this correction in the fall is if we do see the first Fed rate cut in June, July, I think that could juice inflation in the market even further. So maybe by August, September, the realization will kick in that, hey, maybe that's a one and done with the rate cuts, or maybe there's only one more, that sort of thing. So, because let's face it, if there's some kind of correction here in the market, and then the market takes off to new highs in the summer, like the S&P is like 55, 5,700 or something. It's hard for me to see the Fed really wanting to cut rates a great deal. And I think that, if it was that high too, oil would probably getting close to 100, and there's going to be some inflationary pressures. And remember, inflationary pressures also come from spending, and, the rich people control the assets. And if you get like Bitcoin and Nvidia and all these at-risk assets continuing to move higher into the summer, you're going to see something like that. So another thing to watch for in a crash, which we'll talk about, first we're going to show you the price action, is actually, I'll show you this just quickly before we get to the price action. You want to see the internals kind of decline. So this is new 52-week highs, and we can see this hit a new high, and it's still quite high. There was over 100 on the S&P. It was north here. So go look what happened here in 2021. That soared in May. The internals are really strong all through, here, advanced decline line, new highs. Then there was that correction, and that kind of started to have the internals turning lower. Like if you looked at stuff like the advanced decline line, all that sort of stuff, it was much weaker at this top in the S&P than it was here pre this little correction. So what usually happens in a crash or top is that you get some kind of correction like that. That correction you can see here was like 4,500 to 4,300. It was like a 5% correction. It wasn't a big deal, but then the internals kind of lag on that next rally. Like if you remember, Bitcoin kind of topped in October, November of 2022, and didn't participate in that last little move higher with the markets. And Bitcoin actually kind of lagged in that it wasn't much higher, much above its spring high in the fall. So, but notice this huge move. This is what we really want to look at here. So, in the markets, notice how since November, before I get into the 29 chart, notice that since November we've basically gone straight up. The S&P's gone from 4,100 to 5,200. That's a move of nearly 25%, and only whatever it may be, November to like basically 6 months, which is a huge, gigantic move. So this similar pattern occurred in 29 and 87. We're going to look at more at 87 here, in that there was a huge move starting in the fall of the prior year. Then there was this consolidation in the spring and a small correction, and then the blow off in the summer. And the blow off in the summer had weakening internals. It was just led by a few stocks, et cetera, et cetera. Right now we have strong internals, so we're still okay in that regards. But we're going to now go look at the 1987 crash. So we're going to start here in 1986. We're going to start in April of 1986, and we're going to show you, we're going to go to the end of 1987 to see the crash. So, we don't need any of those indicators here. And what we can see here is, again, a correction similar to what happened last year in the fall. And then this bottom, and then the market, the market went from 230 to 340, but same, went from 230 to 300, 70 points higher. And, it's about 25, over 20%, similar to this time. This time the move was more in January, but nothing's going to be exactly the same, right? But you can see just kind of like now, we had potentially a short-term top now. There was a short-term top in April, and then this consolidation in April, May, and then this blow-off into the fall. So if we see something like this in the next few months, where we see this consolidation here, and you kind of can see how this could happen. Maybe stronger jobs reports, strong economic numbers, that kind of thing. But like probably in late May, early June, Nvidia report, and then the Fed could do the first rate cut. So that could juice the market to these highs. And my argument would be, if you were to get, this 280, that was again about a 25% move. So if we were to get, let's say, a 10% correction, or let's say let's say the S&P, I don't know, 4,800 on the correction. Yeah, we could go to about that 25% would be 6,000, but just, I don't know, nothing's gonna be exactly the same. It could go 5,500 to 6,000, in my opinion, on the blow off. And if that happens, I can't see the Fed wanting to continue to cut rates. Who knows? Maybe there was a surprise rate hike here in late September of 1987. Maybe the Fed will quickly shift and take back that quarter point, 3 months later or something. You can say it's an election year, blah, 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 but who knows what can happen now. And again, it doesn't necessarily have to happen like this, because we've seen years like 2013, 1995, etc., where the market just kind of goes straight up, has small corrections, and goes up the entire year. Maybe it's like 1999 and we're in some full year bubble that won't peak till late in the year. Like I showed you, 2021 was like that too. But I think what makes this different is just how overvalued the market is. That stock market, cap to GDP, et cetera, et cetera. So that's kind of what I'm looking at here in the S&P going forward. Now, I don't know if we're going to have this kind of thing, but all I can tell you is I showed you the last 3 years, even in 2021, and a very strong year for the market, there was a correction from August to October. 2022, during the bear market, there was the final correction that took the market to its final low in October. And of course, last year, there was a correction before this straight up move started. So, and again, same thing happened in 86. You can see in 86, there was a top again in late August. The correction, basically there was a double low, late September. But if you had just waited till October, you're never gonna get the exact low anyhow. And then boom, the market went straight up and blew off into September of that year. So, and you don't have much time in this kind of scenario, because remember I was telling you about the Friday before the crash? That was the Friday. So basically the Thursday and Friday were miserable days. And you can see really about the Wednesday before the crash which was right here. We broke support. That's the Thursday, that's the Friday, and that's the Monday. So that's what can happen. Now, crash is a very low probability event. A lot of crashes are different. 1937, 2008 were more crashes that lasted a number of weeks. 1907 was like that too. So it doesn't mean, or 1974 was like that too. Like basically the market had a little peak, a rally in that summer, and then basically went down for a month or two straight. So that, we can see those kind of declines. But I would think that if we see something like this, if we see this kind of correction here for the next few months, and you can see roughly we went from just over 300 on the S&P to about 280. So this correction here was only about 7 to 8%. And then, before the market blew off here. So like I said, 7 to 8% would put us around, 48 to 4,900 on the S&P. And if we see a correction like that, maybe and followed by these new highs, I'd be very, very worried for something to happen in the fall. Now, if we see a correction and then kind of nothing happens, maybe that's going to be a longer correction, and maybe kind of like last year, we'll take off again in the fall. I don't know. You can't predict these things exactly. But usually the two times you get big busts in the market are either the February to April timeframe. We still have April, so we still have a time for something here, or the August to October timeframe. That's 90% of the time when it happens. And with us being through April without a bust, it's probably or through early April. It probably means we're not going to see that now, but we could see it, next year, it'd be more likely to happen this fall. And I think the thing about those election year things is, you go look at 2008 or 2020, during COVID, when it did happen in March, April, the big bust in the markets, everyone thinks that election year is automatically going to be positive. Okay, 2012 and 2016 were pretty strong years for the market. But even in 2016, it didn't really take off until after Trump got elected. So, but 2008 was not a strong year. 2000 was a weak year. So I think this kind of, I think that's kind of a false myth that just because it's an election year means that the market, has to be strong. We've seen in recent times, like I said, 2000, 2008, 2020, some of the largest corrections in bear markets we've seen in recent memories. So, okay, I'm going to leave it at that. I hope you enjoyed this little correlation. So yeah, actually, let's quickly look again at the current S&P. And so again, go look at this 86 to 80, this pattern here where the market, declined in the fall, basically got the straight up move into the spring, had this consolidation here, and then the final blow off into the summer. And the same thing happened in 1929. Let me go look at 1929 stock market. We'll go get some images here on Google. And yeah, you'll see it right here. You see, this is why I don't like these correlations. Like, oh, this one's kind of like, showing that there isn't that strong of a correlation, actually. Seeing this never happened. This was 2013. See, in 2013, nothing ever happened. So that's the thing about it. Like, that's why I'm very reluctant, but I just think with the valuations of the market, 2013, the problem is we didn't have the valuations like we have now, but the 29 chart is here. And again, this was again in the fall of 28. Notice the straight up move, and then into kind of like that was the straight up move, and then there was this kind of sideways pattern that I think that was right here was January. That's when the top happened, and then January of 28, January 29, actually the market actually did nothing, believe it or not. It did make a slight new high here, but that was until about May, same thing. Then that final kind of blow off here that happened during the summer. So it was very similar that way in 29 as well. Let's see if we can find an actual 29 chart. Actually, this one here shows it here. This is better. This is a monthly chart. So yeah, here you can see it. Yeah, well, this was the final thing. So coming out of that correction, this is just the final blow off. That's the final blow off. But going back, like this consolidation had been happening since about, January. It was a longer consolidation than 87. Again, nothing's going to be exactly the same. And then this final blow off happened in the summer. And then you see this decline here. And then there was a little bounce, and then everything completely fell apart. So there you go. What was interesting, that's actually the crash low that we know. And the early November low was actually lower. That's always the thing that's always kind of interesting about 29. So so you can see, if everyone has these things, we're here, this and that, all this kind of stuff. So that's essentially what we have. Actually, this will even show it even better. Sorry about this. This is when it happens. What happens sometimes when you're doing things a little off the cuff. That's okay. Yeah, so this is 29, and this is the weekly, and you can see it again. This is that consolidation I was talking about. Notice that peak at the end of January I talked about. Really, the market did nothing. There was a slightly new high here. That's the May low, and then boom, the last zoom. So if we're going to see that kind of crash scenario, we're in something like this right now, I would say, where the market got very frothy, et cetera, et cetera. We're probably in the few month consolidation, and et cetera. By the way, one thing I'll never do to you is those stupid pop-ups like that. If you want to sign up for my email list, you can do it. I hate those things. I'm sure you're like me, that you're trying to look at something like that, and a video pops up or the email thing pops up. I understand it's how some of these sites are building their email lists, but I find it annoying. I find I'm less likely to sign up for your email list if you got that in your damn site. If you have a link on your top of your site that says sign up to our free email list, I'm much more likely to click on that than I am to fill out one of those things. Okay. Anyhow, I digress. So yeah. Anyhow, so to get back, we'll just finish off and look at the S&P. And yeah, so right now you can see again, this is coming from the lows here in 2022, but this straight up move here. And, if we are in that 29.87 scenario, we probably need to see that consolidation I just talked about, that for a month or two, and then really move higher. And I just want to show you a 10-year chart. I'm going to take the log scale off. You can just see again how parabolic we're getting. Like, go look what happened here, after COVID, and we're kind of doing something similar. Now, this occurred from this low here to this high here. It was about 21 months. Now, if right now we're about, let's say 3, 15, 19 months. Same kind of thing, right? Again, if we have a summer peak, which is 4 months away, be 23 months. Again, nothing's gonna be exactly the same. And notice, when something like this happens, you get those straight up moves. You see the same thing happen in 2019. Boom, you had the COVID crash. In 2021, this. So, so I think that's why we are going to see something. And it's hard for me. I did think that the market would hold up into the election, but remember, that was like at the beginning of the year. I thought that when we were at these highs, and I didn't think we were going to continue this ascendancy. I thought we were going to see something a little slower, kind of like we saw in 2016, 2017. We were going to see something a little slower to the upside, but this has been even, accelerated since essentially those lows of October. So anyhow, I think I showed enough here too. So let's just see what this plays out. Like I said, if we were in that low probability, it is a low probability of a crash. we'd probably see a short-term consolidation here, followed by a high into the summer. Thanks, everybody, and take care.